Okay, good afternoon. Can you see me and hear me well? Okay, thank you. We wait for another minute for other students to join and then we start. Okay, good afternoon to everyone. So what we're going to do today is to focus our attention on the applications of value at risk models. So we've basically seen all the different approaches to estimate value at risk. What we're going to do today is see how these measures can be actually applied in practice. And then what we're going to look at is what are the main problems of value at risk models. And we'll talk about the issue of the size of the losses and of sub-additivity. And we'll discuss an alternative risk measure, which is growing in terms of relevance. And we'll see that this is also recently been adopted by the regulators, which is conditional value at risk or expected shortfall. Okay, so these are the subject that we're going to cover today. And if we manage to, I'll also say later on a few words about capital requirements on market risks. So what are the main applications of value at risk models that we saw so far? So first of all, the importance of having a common risk language within a financial institution. This is extremely important, as we will see. The point here is that rather than having different languages within risk management, we do have a common language. Think, for example, about people who are dealing with, example, fixed income, where typically the terms that are commonly used for risk measures are things like duration, modified duration, convexity, basis point value, or for example, for option trading, where we talk about delta, gamma, and coefficients that you will be analyzing or you have analyzed with Professor Saita. Now, of course, all these risk languages, these risk measures are not comparable with each other, while if we use value at risk, this can easily be compared between different desks or different instruments. The second main application is the one of risk-adjusted performance, i.e. Indicators that give you an idea of what is the return on risk. As we will see, all risk-adjusted performance measures like RORAC, RAROC, and so on are simply computed as ratios between the profit, be it an ex-post profit or an expected profit for the future, with a risk measures like value at risk. Then, a third important application is to set risk limits. These are limits that are set ex ante, so they're very different from, for example, stop loss limits that only apply ex post. Value at risk limits in some way are constraining the different risk takers on the fact that they cannot take a risk higher than a given limit, okay? And that is very important, and it's very commonly used out there in the market. And finally, risk-adjusted pricing. This is something that we'll see has an application more in credit risk, where banks and financial institutions can in some way be a price maker and not only price taker. Clearly, in liquid markets, it's very difficult for a financial institution, for a bank, to make the price, because it's clearly a very liquid market where elasticity is very high. And but in other contexts like credit risk, that is very common. Okay. Now, the first application, as I mentioned, is a common risk language, which is very important. As you know, value at risk is expressed as a maximum potential loss with a certain confidence level in a given time horizon. This allows to have a common definition of risk, and it allows to aggregate different types of risk, compare the amount of risk taken by different business units, and get at the same time a measure of global risk for the entire bank. Okay. Here you have a very simple example. You have two positions. One is a position in treasury bonds, and the other one is a position on a call option. It's a currency option on US dollars. As you can see, for the treasury position, you have the amount, you have the modified duration, so the value, the modified duration, the convexity, and the yield to maturity. Therefore, the value at risk of the treasury position can be obtained, as you can see in the first equation, by taking into account the sensitivity, 7.36, which is modified duration, the volatility, 0.25%, and the multiplying factor alpha of 2.33, which allows to obtain a 99% confidence level value at risk. Then it's also adding the second term, which is modified convexity times, as you can see, the potential change in interest rate squared. And what you get is 4,000 euros, 4,150. For the call option, here what you have is the difference between the final value of the option with the two relevant factors, the spot price, i.e. the exchange rate, and the volatility shocked by a multiple of the standard deviation, and the initial value of the call option, so similar approach, and what you get is 2,000. Now these two values, 4,150 and 2,679, can actually be compared. I mean, if you look at the two original positions, the coefficients we have, i.e. modified duration, convexity on one side, and delta on the other side, cannot give you an idea of which is the comparative position in terms of risk of the two positions. Now, with these two measures, we can have an idea, and we can conclude that the treasury position is relatively more risky. And that allows you to do that because you have already incorporated the different sensitivity, the different volatility of the underlying factors, and therefore this is a significant advantage. Of course, this also allows you to aggregate risk among different positions, of course, moving from that mapping to the risk factors that we analyzed when we spoke about parametric value at risk. The second relevant application is risk-adjusted profitability. Now, risk-adjusted profitability can be estimated either ex ante or ex post. Ex ante, what you do is you compare an expected profit over value at risk while ex post, what you compare is a realized profit or loss over value at risk, okay? Now, you can see in the market many different acronyms that are used, like RAROC, which stands for Risk-Adjusted Return on Capital. There's also RORAC, Return on Risk-Adjusted Capital. There's also RARORAC, but I mean, at the end of the day, they all mean the same. A simple ratio between the profit on the numerator and a risk measure, value at risk, at the denominator, okay? Again, let's look at a simple example. Assume you have on one side a bond portfolio with a market value of 25 million, a monthly profit of 150,000 euro, and the simple profitability is 0.6%. On the other side, you have an equity portfolio, which is worth 25 million, a monthly profit of 250,000, and a profitability which is 1%. So apparently, the equity portfolio is more profitable than the bond portfolio. Now, let's assume we have the data concerning the volatility of interest rates, 0.5%, and the volatility of the stock market, 5%, and the sensitivity. The sensitivity in one case is modified duration, the average modified duration of your portfolio, of your bond portfolio. In the other case is the average beta of your stock portfolio, which is 1. Now, with these data, with these estimates, you can compute value at risk for the two portfolios. In the case of the bond portfolio, it would be 25 million times 5 years, the modified duration, times volatility, 0.5%, times alpha, the scaling factor. In this case, is assumed to be 2. A scaling factor of 2 is equivalent to a confidence level of 97.5. And what you get is a value at risk of 1.25 million. On the other side, you have the value at risk of the equity portfolio, which is again 25 million. 1 is the sensitivity, the average beta. 5% is the volatility of the stock market return. And again, a scaling factor of 2. Therefore, the value at risk of the equity portfolio is 2.5 million. Now, with this data, you can now compare the profit with value at risk, i.e. compute a RAROC measure, which in this case is going to be higher for the bond portfolio than for the equity portfolio. Therefore, in some way, it would be more efficient, more rewarding for the bank to allocate capital to the bond portfolio, which has a higher return on risk. It's basically using a similar amount of capital, i.e. a similar amount of risk, it would be generating a higher return, okay? i.e. it has a higher return on risk, okay? As I said, there are many different measures that are used, RAROC, RORAC, RARORAC, but at the end of the day, they all really mean the same thing, okay? A third important application is the one of risk control, i.e. apply risk limits to different trading desks, to different units of the bank. And this is, of course, extremely important because it's basically giving a risk unit a limit, which is basically telling them how much capital they can use. Here is a simple example where each unit, treasury bonds, treasury bills, forward rate agreements, interest rate swap, has a given limit in terms of euros. And clearly, the head of the trading can modify the allocations, the limits, to the different units, but each unit knows what is its limit. And let me give you a very simple example. Let me activate the share screen so that now the key point I want to highlight is the following. We know that, for example, in the parametric approach, value at risk is equal to the market value times the sensitivity times volatility times alpha, okay? Now, the point I want to make is, assume you are a risk taker and you're given a risk limit in terms of value at risk, okay? Now, if this is the case, let's assume that at some point in time, you are, say that this value at risk limit is equal to 100 million, okay? And say that at some point in time, given an increase in volatility, this value becomes equal to 120 million, okay? Now, in this case, you don't have to change anything with the structure of the limits. The risk taker knows that in a situation like that, given the value at risk limits, because volatility has gone up, he or she has to reduce the market value of its position, of his or her position, okay? So that's very important. It's an automatic risk control system whereby if volatility in the market, if the market becomes more volatile, i.e. more risky, then automatically the risk taker has to reduce its position, okay? Without anyone having to tell them that they have to reduce this position, okay? So this is the beauty of this kind of ex-ante risk control mechanism, okay? Okay, having said that, what are the, let's say, problems of value at risk models? We discussed what are the applications. Let's see what are the problems. Now, what I'll do is very quickly go through a number of very common critiques that are usually attributed to value at risk models, which you will see I do not fully share, and then we'll move to what are in reality the real problems of value at risk models, okay? Now, first critique to value at risk models, they do not take into account exceptional events. This is very common. Some people tend to argue that value at risk models are not able to capture what happens during significant shocks in the market, i.e. very extreme events, okay? Now, I think one can reply to this critique in two ways. First, of course, it very much depends on the confidence level that you choose. I mean, if you choose a 99.9% confidence level, of course, you will be taking into account also, the very extreme of the tails, and therefore you might end up capturing these events. But the more relevant answer to this critique is that value at risk models are not actually aimed at capturing extreme events. This is typically done through different methodologies, like stress testing that we analyzed last time, okay? Because if you were to measure risk in your day-to-day management of a financial institution by taking into account what might happen with a 10-time standard deviation or, say, with an extreme shock, then, of course, it would be impossible for you to impose risk limits and measure risk-adjusted performance using these kind of magnitude events, because you would never be able to generate enough profit to compensate for that. So in reality, there is a different tool, which is stress testing that can be used for this purpose. The second critique is that value-at-risk models do not consider customer relationships. This is very much common in credit risk, as we will see later on in the course. Some people say, well, that's a very nice model, but if I use it in practice, then I end up with a problem because I would price, for example, my loans at a level that all my customers will not come to me anymore. And of course, there is a market out there, and we have to take that into account. Now, again, this is something I don't fully agree with. And the reason being that quite often, those who put this critique forward are not taking into account that basically value-at-risk models are just tools. So if the value-at-risk model tells you that the risk you're taking is not adequately compensated by the profit that you expect to make, then you might want to understand what is the underlying reason for the customer relationship. What the value-at-risk model is telling you is that you are not compensating risk enough. And so it might well be the case that this relationship is not worth. And therefore, one has to take that carefully into account. Eventually, like saying, well, you know, in the future, there will be other things that I can make a profit with this customer. I must admit, this is very common in big banks. For example, when you have to approve a large loan to a corporate, you typically have a RAROC measure and eventually an EVA, an economic value added measure. And sometimes the RAROC is not compensating enough the cost of capital for the bank. Okay. Now, this is eventually because there are other things that you're doing with that customer that are more than compensating. But again, this is a bit risky because it would mean that there is some kind of a phenomenon which is called cross-subsidy, i.e. basically say the loan is destroying value, is not generating enough profit for the risk that the bank is taking, and then maybe there is a service like a payment service or a derivative that you're selling to the customer that is compensating for that, okay? And I say that this is a bit dangerous because what happens quite often is that what you end up with is that some other bank may end up stealing the profitable activity, and you're going to be left with the one which is destroying value. Anyway, this is a critique that, once again, I do not fully share. Third critique is value-at-risk models are based on unrealistic assumptions. Now, again, people say you're using a normal distribution assumption, but this is not consistent with reality. And so the value-at-risk measure that you get is not appropriate, is not correct. Now, the point here is very simple. When you want to measure risk, you always have to make an assumption. We saw that with historical simulations. We saw that with Monte Carlo simulations. You always need to make an assumption. So clearly, every assumption has its strength and weaknesses. It's just an arbitrary choice of what assumption you think is more realistic and better for you, okay? But you always need to make an assumption. And the fact that some people end up saying, we don't want to use these models because there are unrealistic assumptions, and we do not use any model, then, you know, it's like saying that you are sailing without any instruments that would guide you, you know, across the Atlantic, across the ocean. Every instrument has its own limitations, but you need to understand what are these limits, when actually they become relevant, and how you can in some way take that into account, okay? Fourth critique, value-at-risk models produce different results. Well, you know, that is partly true. We saw that when we compared, for example, the results coming out from the same portfolio, same sample period, from parametric approach or historical simulations. And we saw that sometimes these results may be different. If we use the same sample period, the same confidence level, and so on, they tend to be different, but it's very rarely the case. They are very different among each other. But again, the fact that there are differences is just related to different assumptions underlying different methodologies. And of course, this does not mean that they are useless, okay? You will never get exactly it right because you're still forecasting. I mean, defining a risk measure means trying to understand what is the potential loss in the future. And of course, nobody knows how the future would look like exactly. Fifth critique, value at risk models amplify markets instability. This was a critique that was put forward some time ago by the economists. The argument they put forward was the fact that if all banks use value at risk models, then, and so, for example, they use them for setting risk limits, what might happen is that when there is a market shock, they are all in some way getting the same significant increase in risk, which might lead all of them to close the position, say, for example, to sell the position. And by selling, they would amplify the market shock, the volatility, and therefore again increase value at risk, okay? And in this way, generating a vicious circle that would amplify market instability. Now, I don't say that this argument is completely wrong. No, I think it's correct. But the point here to me is, first of all, not all banks use the same models. And second, this is not related to value at risk. It is related simply to human behavior. It has always been the case when there is a market shock, say, for example, something you lived, i.e., 1 year ago, when the pandemic crisis emerged, clearly there has been at that time a significant drop in stock markets everywhere in the world. That is because, of course, this was also generated by the fact that there was a lot of uncertainty, volatility significantly increased, risk went up, and many asset managers, investors, and alike closed their positions by generating this way a significant market drop, okay? But this is very much human behavior. It would work exactly the same with stop loss limits and every other kind of risk limits. It's not value at risk models that generate this instability. So, you know, unfortunately, this is a problem, but it's not actually strictly related to value at risk. Finally, value at risk models do not react quickly enough. Well, again, this is something we analyzed together. We saw that one can construct a value at risk model in a way that it becomes more reactive or less reactive. For example, we can use a low lambda in a parametric model. Or, for example, in an historical simulation, we can move to the hybrid approach with a low lambda. That would make it more reactive. But that's everything we can make, not more than that, really. So, you know, again, it very much depends on how you design your value at risk model if you want it more or less reactive to market conditions. Okay, so those were just my opinions. Of course, these are something that is often being debated, and everyone can has its own opinion, but these are very common critiques. Okay. Any questions so far? You still see me and hear me well, right? Okay. Now, let's move to the real problems of value at risk models. Now, the first problem is that they do not take into account the size of the losses. Remember, we discussed this issue when we discussed the back testing, okay? And we saw that when we want to back test the value at risk model, the only thing we can do is look at the frequency of the exceptions, i.e. the number of days, the number of times your P&L produces a loss which is larger than value at risk. That's really the only thing you can do, okay? Because by definition, value at risk does not look at the size of the excess losses, i.e. how much we could lose when we do lose more than value at risk, when there is indeed an exception, okay? But clearly, from a risk management point of view, this issue, the size of the losses, is a very relevant one. So yes, it's not part of the definition of value at risk, but it is a very relevant issue, okay? And this is one real problem of value at risk. For example, let's look at these two portfolios. These are stock portfolios. And what you have here, these 1 to 10, are the 10 worst losses out of 500, okay, related to two portfolios, portfolio H, portfolio K, okay? Now, as you can see, these two portfolios have a different risk profile. These are the 10 worst losses for portfolio H. The worst of all is 150,000, then 120, and so on, down to 40,000. The second one is 60,000, the worst, down to 30,000, okay? Now, clearly, in terms of potential losses, you could easily see that portfolio H is much riskier. Now, if you compute value at risk for those two portfolios with a 99% confidence level, now if these are the 10 worst losses out of 500 possible results, now if we want the 99% value at risk, we would cut the distribution of losses at the 6 worst, because we would end up losing more than 50,000 only 5 times out of 500. So this 50,000 here is value at risk with a 99% confidence. And you can see that value at risk 99% confidence level is the same, exactly the same for the two portfolios. But we can easily see that portfolio H is more risky. For example, value at risk is the same, but the maximum loss here is 150, here is only 60,000. The maximum excess loss, i.e. the difference between the maximum loss and value at risk, is 100,000 for portfolio H, is only 10,000 for portfolio K. The ratio between the maximum excess loss and value at risk is 200% here, 100 over 50, and it's only 20% here, 10 over 50. The maximum excess loss over value at risk is 200%, 20%. The expected excess loss, i.e. the expected value of the loss when the loss exceeds value at risk, it would be the average of these excess losses, okay, is 50,000 here, is only 5,000 here. This is the average value of these losses minus value at risk, 50,000. It would be 50,000 here, 5,000 here. If you compare these expected excess loss to value at risk, you have 100% here and only 10% here. So by a number of different measures, we can easily see that portfolio H is much riskier than portfolio K, but value at risk is the same, okay? Now, so this is the first problem we need to focus on, the size of the losses, okay? And keep in mind this average excess loss, which is important. A second problem of value at risk measures is the so-called sub-additivity problem. What is sub-additivity? Sub-additivity is a property that we would expect a coherent risk measure to possess. And what is sub-additivity? Well, sub-additivity means that if we have a portfolio Z, which is made up of two assets, X and Y, so say, for example, these are two securities, X and Y, and this is a portfolio which is the combination of these two securities, then the risk function F of X and Y of the portfolio should be lower or equal to the sum of the same risk function applied individually to the security X and security Y, okay? This is, for example, the case of standard deviation. The standard deviation of the returns of a portfolio composed of X and Y is always lower or equal to the standard deviation of the return of a portfolio of a position X and the one of position Y, okay? Remember, it's very simply portfolio theory, okay? Now, in the case of value at risk, unfortunately, if we abandon the normal distribution assumption, then in some particular circumstances, it could well be that value at risk does not respect the sub-additivity property, i.e., that the value at risk as a risk function of the portfolio X and Y together is larger than the value of risk individually, the sum of the two value at risk for security X and security Y, okay? Now, let's look at a alternative risk measure, and then we'll look more clearly to this problem of sub-additivity with a full example, okay? Now, the alternative risk measure is indeed expected shortfall, which sometimes is called extreme value at risk, and sometimes is called CVAR, conditional value at risk. Now, expected shortfall is the expected value of the losses that the portfolio could suffer in the 1 minus confidence level worst case during the time horizon T. So, if we define value at risk as the expected profit minus the loss associated to the confidence level that we have decided. Remember, when we discuss value at risk, we always assumed that the expected value of the profits was zero. We assumed a zero mean distribution of returns. But otherwise, we have to take into account also the expected value, okay? Now, expected shortfall would be the expected profit minus the expected loss conditional on the fact that the loss is greater than the loss corresponding to the confidence level. So, for example, in the example here, value at risk was 50,000, okay? Now, the expected shortfall would have been the expected value of the losses exceeding value at risk. So the expected value of these losses, okay? Let's look at a simple example. Well, before that, from an economic perspective, the difference between expected shortfall and value at risk can be seen as, let's look at these definitions a bit carefully. The expected costs that the authorities would incur to bail out a bank if its capital were not enough, assuming that the bank capital is equal to value at risk. So, assume a bank has a equity capital that is equal to value at risk. Now, expected shortfall is the expected value of the losses, conditional of the fact that the loss is larger than value at risk. Now, if this is the case, assume that the bank fails because losses are larger than value at risk, then the expected cost that the authorities have to incur in bailing out the bank is indeed the difference between expected shortfall and value at risk. Okay? The second definition, the expected payment that an insurer would have to face if the bank had insured itself against the risk of excess losses over value at risk. This is a very similar definition. If the bank has insured itself against losses larger than value at risk, then the expected payment that the insurer would have to face is exactly the difference between expected shortfall and value at risk. And finally, the risk-neutral cost the bank would face if it wanted to insure itself against the risk of excess losses. This is exactly the same as the previous definition. If we work in a risk-neutral world where insurers would not be compensated for the risk they take, then of course the expected payment that they would have to face is the cost for the bank to get it to be insured. Okay. Okay. Any questions so far? You still see me and hear me well? Sorry if I check, but just want to be sure. Okay. Okay, let's go on. Let's look at a very simple example. Assume we have a portfolio with two bonds, and both have a PD of 5% and a recovery rate equal to 70%. Now, the recovery rate is equal to 70% with probability 1% or 90% with probability 4%. So, to sum up, security A and security B, they have the same probability distribution. So, 95% of the time, they don't default. So you get back 100, okay? 5% of the times, they default. 4%, you get back 90, recovery rate 90%. 1% of the time, you get back 70, okay? Now, based on this data, we can compute an expected value, which is 1% times 70 plus 4% times 90 plus 95% times 100, which gives us 99.3, which is the expected value for these two bonds, okay? Now, based on that, we can compute the probability distribution of the changes. Now, if they default and they go to 70, I would lose 29.3 with respect to the expected value. So my expected value is 99.3, I only get 70, so the expected loss is 29.3, okay? Second, they go to 90, in this case, the expected loss would be 9.3, okay? Third possibility, they don't default, and so my expected profit with respect to the expected value is 0.7. 95% probability. Okay? Okay. Now, what is the value at risk 99%? Well, the value at risk 99%, I cut the distribution here at 1%, would be this value, 9.3. Why? Because only in 1% of the time I would lose more than this scenario, okay? And if I do lose more, I go to 29.3. So 9.3 is value at risk 99%, okay? Now, what about expected shortfall? Expected shortfall would be the expected value of the loss conditional on the fact that I lose more than value at risk. Now, value at risk is 9.3. If I lose more than 9.3, there's only one event, which is a loss of 29.3. So in this case, my expected shortfall is 29.3, okay? So this is value at risk. This is expected shortfall for both securities, okay? Now, what about if we combine a portfolio made up of both security A and security B? Now, assume that the outcome of these two securities is independent. So the probability distribution is just built up assuming independence among the two securities, which means that I just have to multiply probabilities. So, for example, I would have to assume that one event is they both default and go to 70. They both have a probability of 1%. The probability that they both default and go to 70 is the product of the two probabilities, 1% times 1%. And this is it. 1% times 1% gives us 0.0%, and the outcome would be 140. They both go to 70. Therefore, my portfolio value would be 140, okay? Second event, security A goes to 70, security B goes to 90. In this case, the probability would be 1% times 4%. And here it is, 0.04%, I get 160. Third event, security A goes to 90, security B goes to 70. Again, it would be 160, probability 0.04%, and so on, okay? This way, I construct the entire probabilities distribution of the portfolio made up of the two securities A and B, okay? By the way, here you have the individual probabilities of each scenario, and here is the cumulative probability. Now, some of them can be combined because, for example, here I have 160, 160. The cumulative probability would be 0.08. I have 170, 170. The cumulative probability would be 1.9. I have 190 and 190, and so on. This is what I get by summing up the ones that give rise to the same event. So I have 6 possible events, 140 with a probability of 0.01%, 160 with a probability of 0.08, 170 with probability 1.9, 180 probability 0.16, 190 probability 7.6, 200 probability 90.25. Now the expected value, not surprisingly, is just the sum of the two expected values, i.e. it's just the sum of 99.3 plus 99.3, i.e. 198.6. What about value at risk? Well, if I have to cap the distribution at the 1%, the cumulative probability would be 0.09 here, but here it becomes too high, 199. So I have to cut it here, okay? Therefore, it would be 170, which if I compare it with the expected value, would be a loss of 28.6. Because if I move to 180, then the cumulative probability would be 199, 2%, and therefore this would be a 98% confidence level, not 99. So value at risk would be 28.6. What about expected shortfall? Expected shortfall here would be basically the expected value of the loss conditional on the fact that you lose more than value at risk. So there are two possible scenarios here, 140 and 160, where you lose more than value at risk, okay? So how would we go about here? Basically, the way it would work would be, give me just 1 minute. And to activate the usual stuff. Okay, so basically what you have two scenarios. One is 140, and the loss here would be, with respect to the expected value, 58.6, and 160, and the loss would be, in this case, 28. Sorry, no, it would be 106, 38.6, okay? And the probability here in the first one would be 0.01%, and in the second one, 0.08%, okay? So that's what you get. These are the two scenarios where you would lose more than value at risk. This is how much you would lose in excess of the expected value, and these are the two probabilities. So what would be the expected value of the loss conditional on the fact that you lose more than value at risk? It would be 58.6 times 0.01 over 0.09, which is the sum of the two probabilities, plus 38.6 times 0.08 times divided by 0.09. And this actually is equal to 40.82, okay? 40.82. This would be expected shortfall. So what you can see here, which is important for us, is that value at risk is 28.6. The two securities had an individual value at risk of 9.3. So the value at risk of the portfolio is indeed larger than the sum of the two securities' individual value at risk, i.e., it's not respecting sub-additivity. While expected shortfall, 40.8, is less than the sum of the two expected shortfall. Each one had an expected shortfall of 29.3, okay? Is that clear so far? Now, expected shortfall, just to give you an idea, it's important to understand, is, think about, for example, when we computed value at risk using the parametric approach, and basically say, cutting the distribution here. Say that this is 2.3 times standard deviation, okay? And this is indeed our value at risk, okay? Now, expected value at risk is the expected value of the loss conditional on the fact that you lose more than value at risk. Therefore, is the expected value of this tail, okay? This expected value is expected short, okay? Is also called conditional value at risk, or CVAR, because it's conditional on the fact that you lose more than value at risk. So now think about it. In this case, we addressed both problems that we saw. First, it is looking at the size of the losses, because it's not simply cutting here and forgetting about how much you could lose when you lose more than value at risk. It is indeed looking at the size of the losses in excess of value at risk. And second, as we saw in the example, and you can trust me, by definition, expected shortfall, whatever is the distribution you assume, is respecting sub-additivity. Therefore, expected shortfall is theoretically a better risk measure than value at risk. Having said that, if you ask me, is it very much used out there in the market? The answer is not yet. Most institutions, most financial institutions out there are very much still using value at risk. However, as we will see next time, market risk capital requirements are moving over time from value at risk to expected shortfall in terms of what banks could do with their internal models. And if this is the case, of course, expected shortfall will become more and more relevant. Okay? Any questions so far? Okay, let's look at a few examples. A few questions and exercises. A bank holds two positions in stocks and T-bonds respectively. The stock portfolio is currently worth 80,000 euros and has an average beta of 95%. So the bond portfolio is worth 80,000 and has a modified, the stock portfolio is 80 and has a beta of 0.95. The bond portfolio is worth 100 and has a modified duration of 7 years. Okay. The volatility of the percentage changes in the stock market is 15%, while that of the yield is 2%. Okay. Based on 99Y, which of the two portfolios is currently riskier? Well, here you have the data. The bond 100, modified duration delta is 7 years, and volatility is 2%. Stock 80, 0.95, 15. So you compute value at risk. It's asking 99%. So for bonds and for stocks, it would be 100 times 7 times 2% times 2.3. That would be 80 times 0.95 times 15% times 2.3. So I don't exactly recall the numbers, but here it's probably around 7 times 2 for 15%, 14 times 2.3 would be around 20 and something. And this is, well, you have, I think, the results here. Yes, the stocks is 26, the bond is 32 and something. So basically, as you can see, the riskier is the bond portfolio. Then it's asking you, how would the result change if the bank were to adopt a 95 value at risk? Well, 95% value at risk would change nothing, meaning that rather than using 2p, you would use 1.65, and therefore the ranking of the two would be exactly the same. The bond portfolio would continue to be riskier. Then it's asking you what would happen if given the equity portfolio were to change to 15. Well, simply again here, you have to change that. Sorry, forgot the question. 25. So basically here, you would have to change this to 25, and clearly in this case the stock portfolio would become riskier. But here you have all the solutions in this table. Okay. Second question: the fixed income desk of Bank Alpha has been assigned a value at risk limit computed at a 99% confidence level of 10 million euros. Currently, the market value modified duration of the portfolio is the market value modified position portfolio are 100 million and 3 years. Okay. The yield curve is supposed to be flat and the volatility is 1.1%. Okay. First, check if the desk is exceeding the value at risk limit. Then outline 2 alternative strategies to align actual value at risk with the value at risk limit. Okay. So very simply, these are the data. Value at risk is the limit 10 million, market value 100 million, modified duration 3 years, and sigma is 1.1. So your value at risk currently would be 100 times 3 times 1.1 times 2.3, which would be basically something around 7 million. So it's below the limit. Okay. Second question, 2 alternatives search to align value at risk with the value at risk limit: a sale purchase of bonds, a bond trade to change duration. Well, in this case, you know that your maximum value at risk is 10 million. So what you have to do is change either the duration or the market value. If you change the market value, that would become the unknown times 1.1 times 2.3, and you solve this equation for this unknown. If on the opposite case, you want to change duration, this becomes the unknown, and you would have to find out what is the modified duration would make the value at risk of your position equal to 10 million. And again, here you have the different values. Okay. So it would be 130 the market value and 3.9 the duration that would solve that question. Okay. Then it's also asking you, finally, suppose market experiences shock and volatility increases to 3%, how could the portfolio be recalibrated? Well, in this case, clearly, if this goes to 3%, you would end up above the limit, quite clearly, above the 10 million limit. And so once again, you would have to change the market value or the modified duration, just as we did before, in order to have you respect the limit. Okay? The value at risk of a portfolio made of 2 positions is 50 million euros. In which of the following would parametric value at risk increase because one of the 2 positions has been sold? Okay, I'll leave it to you. Give you 1 minute and then you tell me what is the correct answer. Okay, what is the correct answer? You tell me. Okay, it's relatively easy. At least one answer I want to see. Come on. See if the 2 positions have the same sign and are exposed to negatively correlated market factor. Correct. Which of the following statements are true? From an economic perspective, expected shortfall can be interpreted as value at risk plus the expected cost that the government would have to pay to sustain in order to save the bank if its capital assumed to be equal to value at risk were not enough to cover that. The dividend the bank would have to pay to its shareholders in order to make it attractive for them to pay in a capital equal to value at risk. Value at risk plus the risk-neutral cost the bank would face if it wanted to insure itself against losses larger than value at risk. Value at risk with a 100% confidence level. Okay, what are the correct answers? Come on, you bet. What is the correct answer? C. Let's see. Yes, the correct answer is C. 1 and 3. 1, value at risk plus the expected cost is correct. The dividend has nothing to do. Value at risk with 100% confidence level is yes, 1 and 3. Correct. 100% confidence level clearly is not correct. Okay, so the correct answer is C. Last question. Based on the following probability distribution of portfolio losses and using a confidence level of 95%, compute value at risk and expected shortfall. Also, highlight how the value at risk and expected shortfall, still with a 95% confidence level, would change if the maximum loss, rather than 1 billion euros, were 500 million euros. Now, let's have a look. First of all, value at risk, 95%. It means we have to isolate the losses that would have a cumulative probability of 5%. So if we look at the table, we start from the worst, 0.5, 0.3 makes 0.8, 1.8, 3.4, 4.2, 5%. So we have to stop at 50, right? So value at risk would be 50, okay? So value at risk 95% confidence level would be 50 million, okay? What about expected shortfall? Now, expected shortfall would be the expected value of the losses exceeding value at risk, okay? So the expected value of the losses exceeding value at risk would be basically 60 times its probability, which is 0.8, over the total probability of the losses exceeding value at risk, which is 5%. So it would be 60 times 0.8 over 5 plus 65 times 0.8 over 5 plus 70, yes, times 1.6 over 5 plus 80 times 1% over 5 plus 100 times 0.3 over 5 plus 1000 times 0.5 over 5. I'm sorry, I just looked at the table and didn't show you the computation. So value at risk was equal to 50. Expected shortfall 95% confidence level. I take all the losses exceeding value at risk, all of them, and then multiply each one of them by their individual probability over the total probability of losses exceeding value at risk, which is 5%. Okay, so it's an expected value, a weighted average of the losses exceeding value at risk. Okay, and you have it here as well, I think. Yes. So expected shortfall gets to 155.2. Okay. Is that clear? Any question? You can see the computations here. Okay. It's just a expected value, therefore a weighted average, each loss weighted by its own probability divided by 5%, which is the cumulative probability of losses exceeding value at risk. Okay. Second, how the value at risk and expected shortfall would change if the maximum loss rather than 1 billion euros. Oh, sorry, I forgot. This is, in this case, the mean value is not 0. Okay. So the mean value, first of all, we have to compute the mean value here. And this is done here. The expected loss is 9.19. Okay. Now the expected loss is 9.19. So in this case, the value at risk and expected shortfall must both be computed by subtracting then 9.19, okay, minus 9.19, because this is the expected loss, okay, and therefore what we need to compute is the excess loss with respect to the expected value, okay? And therefore, for example, value at risk is 40.81. It's 50 minus the expected loss, okay? Now, when you move to the second part of the question, which is highlight how value at risk and expected shortfall would change if the maximum loss rather than 1 billion were 500 million. Now, this is a bit complex because apparently the value at risk would not change if you change this value here, if rather than 1 billion you have 500. Now, in reality, it does change for the very simple reason that the expected loss would change. The expected loss would decrease to 6.69, and therefore both value at risk and expected shortfall would change. Expected shortfall would also change because the expected value here that we computed here, his would not be 1,000, but rather 500. So value at risk would change because rather than having 919 here, we have a value which is 6.69, okay? And therefore it would change for this reason. Expected shortfall would change because we have this and because this would change, okay? So that was an old exam exercise, and it shows you how expected shortfall needs to be computed, okay? But you have the solution also on the Excel files, okay? Any question on what we saw so far? Okay, one final point I want to make. I recently uploaded on your Blackboard an Excel file which is called RAROC. Now, why did I do that? Now, this is a very simple exercise that shows you how using a risk-adjusted performance measure rather than a simple return measure completely changes your behavior. Now, what it does is the following. It is a simple simulation, looks rather complex, but it is rather easy. Here you have equity markets, and you can take position in euros, yen, sorry, in Europe, in Japan, in the UK, or in the US. For example, if I write buy with a B, 100, it takes 100 million in the Euro top market. If I write sell, it takes a short position in the UK equity market, okay? Here it does the same for the bond markets, and here it does the same for the currency markets. You are a European investor, so you can buy or sell yen, buy or sell British pound, buy or sell US dollars, okay? Now, what it does is every time you take a position, it computes the value at risk of the position, and then it aggregates the position. For example, value at risk equity is basically taking together all the positions in equities, okay, by taking into account correlations. Correlations are an input and are actually here in the data sheet, okay? Then what it does, it computes value at risk for equity, for bonds, and for currencies, and the total value at risk, okay? Then what it does, it computes the total P&L, in this case is a loss, and RAROC, the risk-adjusted return on capital for your position. Now, you have three different scenarios, these three different sheets, okay? Now, these sheets. Now, this scenario one has a number of forecasts, as you can see. For example, equity markets are going down, bond markets are doing relatively well, and the currencies are doing in different ways. Now, you can take very different, for example, you see negative, you can take a short position here and a short position there, or for example, a long position here. But there are risk limits in terms of value at risk. For example, your value at risk for individual positions cannot exceed 25 million. So for example, if I take 1,000 here, it would tell me that this is in an excess. You can't do that, okay? Also, you have a 50 million excess for individual categories, equity, bond, and FX. And the total risk that you can take maximum is 100. And your objective is to maximize RAROC, okay? Now, this is a very nice exercise because if you try to maximize RAROC, respecting all the constraints, gives you an idea of how working with a risk constraint, a risk limit, completely changes your behavior, okay? And you can exercise yourself. Keep in mind that all the cells are protected, okay? The only thing you can write are these blue ones, where you can write the amount of the position buy or sell, okay? And you can do that in three different scenarios. And this is also in this simple page that is describing what I just told you, okay? How you would behave with these different scenarios, okay? So it's a way for you to practice how using two of the applications of value at risk, i.e. a system of risk limits, which is very common in the real world, and at the same time trying to maximize risk-adjusted performance. Keep in mind that there's not only a risk limit upwards, so for example, as we said, you can't exceed 25, so this we can go to 400 maximum, but you also have to use your capital. So I gave you a maximum of 100, you can't go above 100 as a total value at risk, but you can't go below 50. Indeed, it says low risk. And this is because I gave you 100 of risk capital and you need to use it. Because if you only use it 10 million, it's a waste of capital and therefore is suboptimal for the bank, okay? So basically, this is a very simple exercise that you can do to exercise yourself in terms of using a system of risk limits and risk-adjusted performances. You have this Excel file and also the Word file explaining how to use it on Blackboard, okay? Okay, any questions so far? Okay, we have a few minutes left, but we have to completely change subjects and go to market risk capital requirements. So I would actually do it next Friday. And for the time being, I wish you a nice evening and speak to you next Friday. Okay?